unusually high volatility in a bull market that has defied many historical trends in on chain data, there are many pressing questions among investors. As the stock market and the crypto markets are becoming unusually highly correlated, one must ask themselves, what does the future hold for crypto investing? Today, we're going to try to answer some of those questions by looking at the on chain metrics, and we're going to do our best to get down to the truth. As we dive in, please hit that like for me. Many hours of analyzing and researching go into these videos so that you can have free and accurate content. I appreciate every one of my subscribers, and I will do my best to keep you informed. If you are not yet a subscriber and would like to receive real-time updates on changes to the markets and the markets that you are invested in, then please subscribe to the channel and hit the notifications so you don't miss a beat. Today, we're going to start with Jerry Brockman. So Jerry Brockman is the Chief Investment Officer and President at First American Trust. And Jerry stated on Friday that crypto and tech stock investors should not buy the dip. That is an interesting statement since historically crypto and tech stocks offer a much higher profit potential over the long term. What is clear is that there is a war going on against cryptocurrency, and it's no coincidence that the SEC publicly contacted MicroStrategy, the largest corporate holder of Bitcoin, on the same day that news was released that Bitcoin would be banned in Russia. And while the Fed's sentiment has been so hawkish, tensions between Russia and NATO have also raised uncertainty among investors. So why would fear be used to try to draw capital from cryptocurrency back into the equity markets? It's a good question. Brockman also recommended that investors move their investment strategy towards quality stocks, which would ultimately force crypto and tech stockholders to sell off and shift all of that money, all of those invested dollars back towards the stock market. And there definitely are some very strange things happening among the on-chain analytics, showing us that it is pretty much only retail investors, for the most part, who are moving Bitcoin onto exchanges. Historically, every time we've entered a bear market, retail and institutional investors move their Bitcoin onto exchanges in an effort to manage their risk and sell before the losses get too severe. What we are seeing is that this is just not happening. So why would institutional investors be looking to hodl through a potential bear market? This is an important question that we will be looking at today. We'll also be looking at both the stock market and the crypto markets to determine whether we can expect long-term correlation between the two, and if many of the sectors in the stock market are expected to enter a bear market since they are so highly correlated. We will also explore whether we can expect a similar trend in the crypto market, because I know many people are wondering, are we entering a bear market? Before we jump in, I do want to clarify that I am not a financial advisor. This is not financial advice. Investing in risk-on assets and cryptocurrencies comes with risk for loss of capital. The goal of this channel is to dig down into the on-chain data and either provide relevant support for the news and information that we are receiving, or question and expose the potential spread of false or misinformation, or expose manipulation that might be happening in the markets. I have included links to our prior videos in the description, especially from the market analysis playlist. These videos may help build a foundation for understanding correlations between the economy and both the crypto and equity markets. in these videos. Our hope is to put them into easy to understand terms so that you can make the most informed financial decisions. So, jumping into some of the news, Crypto.com has been hacked. In the news, basically, Crypto.com had first stated that no money was taken or no crypto was compromised. Uh, but apparently, Crypto.com has been hacked for approximately $15 million in Ethereum. Representatives at Crypto.com stated that all funds were safe, although initial reports from the exchange stated that no funds were taken. However, analysts found that $15 million worth of Ethereum were taken from the exchange on Tuesday. The Bitcoin dump has been fueled by liquidations. For those of you who've been in the space investing for a little while, know the potential of liquidations and how volatile the market can become. The Bitcoin futures market is signaling impending volatility, with open interest for Bitcoin currently rising above 250,000, which has historically signaled sharp price movements. Reports from Glassnode indicate that perpetual futures open interest has remained elevated above the $250,000 mark for much of January. With the launch of several Bitcoin futures ETFs last year, crypto investors have been able to use futures contracts, which basically, for those of you who don't know, is an agreement to buy or sell an asset at a specific agreed upon price on a specific date. And open interest refers to the total number of unsettled derivatives contracts that are in the futures market. Elevated open interest indicates that the futures market is highly leveraged. When rapid price movements take place, it leads to liquidation of leveraged positions and can bring high volatility. As we can see, this chart, when open interest is high, there are sharp movements in asset price, and we can see similarly in the farthest pink square to the right here that just this month open interest has been extremely high, much higher than we've seen at least as far back as May. We can see the number of liquidations in this graph, which shows how open interest is fueling the recent dump. Roughly around $346 million worth of long positions were liquidated as Bitcoin price crashed. The number of daily active addresses can help us paint a picture of investor sentiment. In this graph, the 50-day moving average of daily active addresses has crossed below the 200-day moving average, indicating a bearish crossover. The last time this occurred was on May 17th and was followed by Bitcoin crashing from roughly 46,000 to 29,000. If history were to repeat itself, there is a good chance Bitcoin price could revisit the $29,000 level, coinciding well with the target forecasted from a technical perspective. A majority of the on-chain indicators suggest a bearish outlook for Bitcoin price and align well with the technical forecasts. However, the bearish outlook can be temporarily sidestepped by Bitcoin if it recovers above the 39,573 mark. Market value to realized value. The market value to realized value, or MVRV model, is an on-chain metric used to determine the average profit loss or loss of investors that purchased Bitcoin over the past year. Currently, MVRV is hovering at around negative 19%, revealing that short-term holders are at a loss. This level was last seen in July 2021, when Bitcoin bottomed at 29,862 and kick-started an uptrend. This index suggests that all hope is not lost for Bitcoin and that an uptrend is likely to begin if long-term investors can come to the rescue. If Bitcoin can close a weekly candlestick above the supply zone's upper limit, which is currently at around 47,257, it will invalidate this pessimistic thesis. A bullish outlook for Bitcoin price needs to be basically what I'm trying to say. For a bullish outlook, Bitcoin price needs to set a weekly close above 52,150. This will set a higher high, allow sidelined buyers to step in. Investors can then expect that we would retest the $60,000 psychological barrier. Bitcoin exchange reserves, as we pointed out earlier, are back near record lows as 2022 sparks renewed accumulating and sending those coins off exchanges. Data from OnChain-Analysis firm Cryptocom shows reserves across 21 exchanges currently hold around 2.3 million Bitcoin. Data from a crypto intelligence platform revealed to us that nearly 10,000 Bitcoin left US-based crypto exchange Coinbase in the first week of January. At that time, Bitcoin was dropping fast below 50K. This data shows us that Coinbase Pro users collectively withdrew around 10,000 BTC just in that week alone. The big question here is why? Why this historical trend has changed? Because historically, when the crypto market is entering a bear market or experiencing a significant pullback, retail and institutional investors usually send Bitcoin to the exchanges so that they can sell it as part of their risk management strategy. However, that is not what we are seeing, and this just does not make sense to us. So unless investors are so confident that, we are still in a bull market, but of course, this could just be an anomaly, right? But the fact that we are not seeing Bitcoin come into exchanges is a very unusual but good sign that markets do have the potential to recover. Bitcoin in the stock market can share a correlation as high as 0.59. The 100-day correlation coefficient of Bitcoin in the S&P 500 currently sits at 0.33. While Bitcoin has long been championed by advocates as an asset uncorrelated from traditional financial markets, we have seen tightened correlation between them recently. For the third consecutive week, all three major U.S. indices experienced severe declines in price, with many investors worried about the prospect of higher interest rates and their effect on valuations. The Nasdaq has fallen for 4 weeks in a row. The Dow Jones Industrial Average finished its worst weekly performance since October 2020. Investors have repositioned their portfolios away from riskier assets, while the prospect of higher interest rates has negatively hit high-flying tech stocks and unprofitable companies with the worst performing shares. These price moves that have moved the Nasdaq down into correction territory are wreaking havoc on the crypto market. The high performers among the shakeout are oil and yields on government bonds. Last week, Fed Chairman Jerome Powell promised that a hawkish move by the Fed to raise interest rates and and said basically he defined rapid inflation as a severe threat to a full economic recovery. It's interesting to note that data showed consumer prices continued to rise through December, though, marking a 40-year high. So, even with the proposed interest rate hikes, interest rates will still remain low, and this may offer some support for tech stocks and the crypto market. What's important to understand here is that the proposed interest rate hikes are just an indicator. They're a preemptive move by the Fed, basically telling us that there will be more aggressive corrective action in the future so that they can manage inflation. Inflation has been soaring following the highest money printing we have ever seen. All that money being printed and sent out to millions of investors in the form of stimulus checks, boosted unemployment rates, and massive business loans at nearly 0% interest has in fact artificially inflated the markets. In my last video, I showed the data that showed the stock market is in a massive bubble, and that bubble has the potential to burst. If the Fed remains hawkish and raises interest rates, that bubble bursting could have vast global economic consequences. Stories about the Great Depression we may have heard from our grandparents may become a reality. I showed that many large corporations have been almost entirely operating on debt. With that debt, they are able to artificially inflate their stock valuations through buybacks and pay for important business expansions, but in the meantime, are basically teetering on the edge, and the stock market has been fluffed up for a very long time, 20 years, in fact. The Fear and Greed Index for equity markets is currently at around 43. The Bitcoin Fear and Greed Index has fallen down to around 11. So let me actually skip ahead. So this is the S&P. I do want to talk about the stock market a little bit, but before I do that, I want to look at the SIBO 5-day average. So the reason why the fear and greed for equities is higher is there is an initial selling going on. So the SIBO 5-day average shows volume in put options has lagged in volume by 73.28%, showing the lowest levels of put buying over the last 2 years. So this is why we are seeing the Fear and Greed Index stabilize in the stock market, since it is seen as extreme greed. So this is what's kind of keeping the Fear and Greed Index in the stock market so different than the crypto market. Likewise, the McClellan Volume Summation Index measures advancing and declining volume on the New York Stock Exchange. Over the past 2 years, an average of 15.37% of each day's trading volume has traded in declining issues as opposed to advancing issues. This basically indicates that market breadth is weakening. Although the McClellan Oscillator is near the top of its local high range for the past 2 years. Let's take a look at the S&P 500. Clearly, the latest downdraft is more than a trivial retreat. For some technicians, the decline that's brought the market close to the 200-day average deserves attention in the days ahead. A slide below this slide basically shows that the average will lead some to forecast deeper trouble ahead. The record on this trigger is mixed, but basically won't stop some tactical oriented traders from treating it as a high probability forecast. A more robust trend profile is looking for periods when the 50-day average falls below the 200-day average. This slide looks at the S&P through a drawdown lens. This slide is a drawdown lens. And basically, what I've done here is that um, what we see here is that the current decline um, is a moderate negative 6.5% as of January 20th. So in this chart, we look at this upside down because these are negative valuations, right? So this blue line shows common noise that we experience in the equities markets. So basically, historical data suggests that the degree of decline may just be noise. As we can see on this graph, a negative 6.5 percent peak to trough retreat for the S&P 500 is a common occurrence across time. And that it may just be noise. For example, in 1960, the median drawdown is only slightly milder at 6.1%. So not much different from 1960 till now. So the big question here, and the one that we are trying to set out to answer here, is whether we are at risk of entering a bear market. For equities markets, we are using a hidden Markov model. So this HMM graph uses econometric evidence or bear market indicators to determine whether a bear trend is in progress or not. The results of this analysis reports that the probability that a bear market is underway in the stock market is currently at 0% probability, while bear market trends in equity markets happens much less frequently and are much less severe than what would be expected in the crypto market. We can use the HMM analysis to help us determine the probability that we are entering a prolonged period of downside volatility, especially over the short and medium term. Since there is currently a tight correlation between the crypto and the equities markets, we can estimate that the risks of entering a bear market are no more probabilistic than seeing snow in Texas. So this chart, um, I've received many comments asking if I think equity markets are in a bubble and if that bubble is going to burst, uh, driving the markets down into the abyss. This slide helps us use data to determine whether the equity market valuations are artificially inflated and at risk for elongated exposure to downside price action. Since the term bubble is not definitively quantified at a high confidence level, we have to kind of take this with it's speculative. So we begin the analysis with an objective quantitative profiling, which is essentially a thumb to the wind indicator to measure the pattern of valuation growth against several other data sets. And we use a rolling 36-month ADF test to attempt to quantify the current state or average amount of bubble risk for the US stock market. The ADF test uses S&P returns at close and p-values over 36 months. While our confidence level resides in the median range for supporting this hypothesis, it is a reasonable first approximation. This is because this method of analysis shows a degree of accuracy for identifying bubbles in real time. Without getting too technical, bubble risk for the S&P has been elevated recently, but the risk has been mid-range and appears to be declining with the recent sell-off and has been tempered enough to assume that it doesn't look extreme at the current moment. As this metric approaches 1, the near-term risk would be considered high. So to the question as to whether or not an equity market bubble is so inflated that we are close to bursting? The answer is it does not appear to be at high risk of bursting at the moment. However, there are many ways that valuations can correct in the short term, and bursting is just but one way that a bubble could deflate. As fear among investors continues to move higher, the probability of a rapid deflation also increases. So, in this next slide, this is the cape. There is a counterpart here, to be sure. The stock market valuation is high, and therefore the expected return is low, or even negative in some cases, depending on how you define valuation. A common method for determining whether equity markets are inflated and determining the extent of the pressure within the bubble, so to speak, is using Professor Robert Shiller's cyclically adjusted price earnings ratio, better known as CAPE, which uses price earnings ratio and interest rates to determine whether valuations are elevated. What we can see here is that they are currently at the second highest level ever on record. While CAPE has been elevated for years, the markets have continued to run higher. This is a counterpoint among many analysts, right? Will it be different this time? How big can the bubble get before bursting, or at least deflating? Understanding how valuations play a role in market corrections has been countered with many opposing viewpoints. I will just say that when the valuation of a company's stock is priced far beyond the company's potential valuation, it requires more and more flow of capital to keep it afloat, and therefore sentiment becomes the main driver of that valuation. Hence, why the Fear and Greed Index can be a useful tool for understanding when there is heightened risk in the markets. The Chicago Fed National Activity Index. Another way to measure risk is to monitor the economy. Basically, as long as the risk of entering a recession is low, there is a lower probability that an extended bear market will take place for stocks. In terms of estimating probabilities, this is a variable that deserves to be in today's discussion. We begin this analysis by monitoring the 3-month average on the Chicago Fed National Activity Index. The latest update we have goes through November and points to low recession risk. We are monitoring this benchmark, and if it begins to drop near the negative 0.7 level, as shown here by the red line, there is a high probability that the economic expansion will continue on without entering into an extended recession. During the past 2 years of COVID-induced market mania, cryptocurrencies have gone up so much. Bitcoin is up fivefold, while many other cryptocurrencies are up far, far more. So far that even reluctant Wall Street institutions have begun to tiptoe into the arena. A blazing fireball of a dump has hit both the stock market and the crypto markets, and fear is permeating all sectors of investments. Whether or not we are in a crypto bubble remains to be seen, but the technology continues to evolve, and there is no stopping blockchain technology from growing over the short term and the long term. Whether prices will fall or rise depends on many variables that we will be watching on this channel. Everything we have covered today paints us a picture of bubbles bursting and raging bears eating us alive. But the on-chain data paints something very different. It paints a picture of fear among investors and not a whole lot of data to support its level of emotion. I suggest to be careful with sound risk management strategies. but also manage your fear and look at the data to determine if we are actually in a fake out and are destined to see all-time highs in the very near future. That is what I got. See you all on the flip side.